thank you so much for tuning into this video to learn about the amazing benefits and tax advantages of transferring your registered assets from your RRSP, spousal RRSP, pensions, and LIRAs over to tax-free savings accounts free of tax. I'm 𝐏𝐫𝐸, founder and advisor with Precedence Private Wealth, and I'm also senior investment advisor with Precedence Capital and 𝐏𝐫𝐸 Securities. One question I want to ask is, what innovative solutions have been provided to you for reducing tax during retirement? And I bet the answer is very few, if any. So the pending problem is that the government owns up to 50% of your RRSP and registered assets, which means future withdrawals can be taxed as high as 50% in later years and upon death. So the solution would be, why not try to maximize the amount of investments that can be made into tax-free savings accounts in order to take advantage of tax-deferred growth and tax-free withdrawals at any point in the future. So we asked the question, what if we could create a bridge that could transfer registered assets such as RRSPs and pensions over to tax-free savings accounts in a tax-free manner? And that's exactly what we created. So for the client example that we're going to illustrate today, we took a 50-year-old couple with $500,000 of registered assets. They also have $100,000 of tax-free savings account assets. In addition, they have $600,000 worth of equity in residential, commercial, rental, or farm property. So step one in the strategy is to take the assets inside the RRSP and the tax-free savings account and sell them to cash. So as you can see here, we are not taking the money outside of these accounts, which means you're not making withdrawals out of the RRSP and forcing taxation at this point, but merely what we're doing is selling the respective securities, and we're actually carrying cash inside the RRSP and the tax-free savings account. Step two involves now investing this cash from inside the RRSP and tax-free savings account into special purpose mortgage vehicles known as mortgage investment corporations. Each account is going to have a different share class which pays different distributions. For the RRSP, you can see there's a 3% distribution, whereas compared to the tax-free savings account, there's a 15% distribution. After we've invested the cash inside these mortgage investment corporations, the actual mortgage corps then re-lend you the money back so that you can borrow to invest in non-registered and taxable assets. Now recall, when you borrow to invest, the interest is tax deductible. What's also important to note is that the RRSP is lent in first position at 3%, and the tax-free savings account is in second position at 15%. Now, why that's crucial is that this is the only strategy where you would want to employ a higher interest rate than you would for traditional lending. So for example, the tax-free savings account, if it was much lower, will be less impactful for the strategy. But because there's higher risk for the mortgage corporation or the lender, because you're borrowing in second position, then it justifies a higher interest rate. And what a second position mortgage exactly means is that in the event of a default, not that you're ever going to default on your own mortgage, but if you defaulted on the mortgage, the lender would be paid second in that share class because the RRSP would be held in first position. Therefore, much more risk, and therefore justifying a higher interest rate. So step four is, now that you've actually set up these mortgages, you have to actually make the mortgage payments. So even though indirectly you've borrowed from yourself, you have to make the mortgage payments. So what we do is we now begin to withdraw money out of your RRSP via a RIF, and that is taxable income. And that's no different than any withdrawal you would normally have out of your RIF at any point in retirement. The difference is that we pull out the exact amount that is going to be needed to make these tax-deductible mortgage payments. Step five involves actually making these tax-deductible mortgage payments. And because the Mortgage Investment Corp had lent you the money in the first place, that's exactly where we make the respective payments. And then lastly, step six is where you get paid back those distributions as an investor. And recall, your RRSP owns the share class that pays a 3% distribution, and your tax-free savings account owns the second share class, which pays a 15% distribution as the respective interest rates. So you can see the money funnels back up into the RRSP and into the TFSA, but at a much larger rate into the tax-free savings account because of the higher interest rate that's attributed to those share classes. Now, it's a little bit counterintuitive moving the money out of the RRSP and then back in, but that's inevitable and part of the strategy, and it's something that you have to structure here. So it's important to note again that the interest on these mortgage payments is tax deductible, which means the exact money that is pulled out of your RIF that is normally taxable is completely offset because of the tax deductible interest, therefore wiping out the tax completely and then employing a tax-free transfer of wealth from registered accounts to the tax-free savings account. So there you have it, folks. Those are the 6 simple steps involved to transfer your RRSPs and registered accounts over to your tax-free savings accounts. So here is an illustration that we have prepared for this exact example. This is the exact illustration that you would receive from us if you were a prospective client trying to learn about what the amazing benefits were and how this would exactly pertain to your individual situation. But I want you to pay close attention to really the benefits. In this situation, a 50-year-old up until age 82 is going to save over $1,049,000 in tax from their registered savings. So it's amazing and it's super substantial. The details are a little bit cumbersome, but this shows you line by line on an annual basis how the cash flows work, and something that we're happy to share if you inquire. So once again, let's review the amazing benefits of this strategy. First, obviously the potential to earn a tax-free retirement income. Second, because investment management fees are carried now in a non-registered format versus in an RRSP, a tax-free savings account, and registered format as they were before, you can now deduct investment management fees. That provides further tax deductions and allows you to build more wealth throughout this strategy. So often overlooked is the potential to maximize retirement benefits. We have clients that have millions of dollars in their RRSP that are actually going to be able to receive old age security and other retirement benefits because on paper, their retirement income is not going to be taxed because of the format of transferring it into the tax-free savings account, whereas compared to having their assets into an RRSP previously. So what that means is because it's a tax-free nature, all the future retirement income, there's no clawback to remove those government benefits, which is actually quite staggering. And lastly, probably most importantly, is that there's 100% tax-free transfer to your estate. So what that means is you're not going to have any taxation whatsoever. Most people don't understand that when you die, 100% of your registered assets are deemed disposed of in the year that you pass and are taxed. And this can be up to 50% taxable. So because your assets are carried inside a tax-free savings account, there's no longer any more tax upon death. So we went through this very quickly. If you want a more thorough explanation, please visit us at precedencewealth.com, and please leave your feedback, questions, comments below. We want to share this with as many Canadians as we can to help improve retirement lifestyles and have the potential to provide tax-free retirements across the country. Once again, thanks so much for tuning in and paying attention to this video, and we'll talk to you again soon.